Welcome back to EDS, and in this video I'm going to show you a super simple strategy that's very easy to implement that you can use in a small portfolio if whether you're a new trader or a experienced trader. I'm going to show you exactly what to do step by step. So the first thing is you want to open up any equities underlying. We've got Microsoft open at the moment. It doesn't matter what you pick, and you simply want to navigate over to see a list of expiration dates for the options contracts on that particular underlying. All equities have the same expiration dates on their contracts. That's why it doesn't matter what you pick. We're not interested in the actual underlying itself. We're just interested in the expiration dates for now. So the expiration date that you want to pick needs to be between 30 and 60 days out. 45 days is perfect, and it also needs to be a monthly, not a weekly or quarterly expiration date. Now, the only expiration date that fits that criteria is February 21st, which is perfect for us today, 45 days out in time. We can take that information, come over to our watch list, and simply filter out any and all underlyings that have an earnings event over the next 45 days. This is because we are writing or shorting these contracts, and that means we're selling high, buying low. Now, as volatility increases, option prices increase, and leading up to an earnings event, volatility tends to increase. And if we're in a position and volatility increases, that's typically going to increase the options price, which is going to be bad for our P&L. So we want to avoid that. And then we also want to filter out anything with a low liquidity rating level. And this is just because we only are interested in trading liquid markets. The more liquid a market is, the tighter the bid-ask spread. The bid-ask spread is simply what you pay every time you get in and out of a position. So the tighter that is, the less you pay, the more profit you keep. Now what you'll be left with is something that looks like this. We've got a pre-made watch list here. This is just a 52-week near the 52-week low watch list. That's automatically generated by the broker. You can use any watch list that you like, and because it's near a 52-week low, we're going to be doing something slightly different to what we normally do, but for now everything stays the same. We want to order everything from high to low IV rank, and we want to see how these underlyings would fit in our portfolio. You want to pick something that would be nice and diverse. Don't be too heavy in any one sector or industry. Use common sense and you'll be fine. So if we have a look down the list here, we've got EWZ, which is currently trading at just over $23. It has an IV rank of 49.3. We've got XLP as well with an IV rank of 47.5. These are both ETFs. We've got TLT, XLV. So we've got quite a good selection here. So let's just start with EWZ. We're going to go over two different underlyings to just show you the difference. So we've got EWZ here, which has got an IV rank of 51.9 and an absolute IV level of 31.3%, which is quite nice for EWZ. So we're going to go over to the expiration dates, click on February 21st, which is what we've selected already, and we are now presented with the options chain. We've got a horizontal line here, orange line, that shows you where the price of EWZ is with respect to the strikes. In the middle here, this column is all of the strikes, and this vertical orange bar shows us what the expected move is of EWZ over the next 45 days. Now, because we found this on a 52-week near low watch list, we're going to be slightly contrarian, and we're going to make a bet that price isn't going to go too much lower, and we're going to hope that price reverses. So what we're going to do is we're not going to sell any contracts on the call side, which is what we normally do. We normally sell one call, one put. We're just going to focus on the put side. So when you're only focusing on one side, instead of being a bit conservative, being around the 15-20 delta, you want to be a bit more aggressive, and you want to be sitting at around the 30 delta mark if you're just taking one side of the trade. So we've got a 28 delta here, and we can simply sell this contract at the 22 strike, which is sitting just on the edge of the expected move, close to the one standard deviation level, and we're pretty much bang on with the delta. Now, as you can see here, we would collect 39 cents of premium. times that by the contract multiplier of 100 for equities, and we get a max profit of $38.39, and our broker is going to require $347 in buying power to open this position. So we're looking at around over a 10% return on capital for just taking one side of the trade, which is very, very nice. And what's the chance of this trade actually coming in our favor? Well, what is the trade setup here? Well, we're selling a contract at $22. We don't want price to go below $22. If price goes below $22, then we're looking at taking a potential loss. If price stays above $22, then we will be absolutely fine. And considering this is EWZ is near the 52-week low, I think we won't have any problems with this particular position. But outside of personal opinions, let's look at the statistics. So we've got a pop of 71%, which means a probability of profit of 71%. That means there is a 71% chance of making at least a penny on this trade at expiration. If we didn't want to hold this position all the way to expiration, and we wanted to get out at say 50% of max profit, we've got an 88% chance of being able to do that. So we're looking at between 71 and 88. It's gone up now to 89% probabilities of success. So very, very high probabilities of success. It only requires $347 of buying power in a margin account, which should fit inside pretty much all portfolios. Now, what I'm going to show you here, if we get rid of that, go back to our watch list, and let's say if we picked a slightly larger underlying XLP, which is the consumer staples ETF, it's one of the spiders. It's trading at $78 right now with an IV rank of 47.2 and an absolute IV level of 17.2%. So if we go over to February 21st for XLP and we just do the exact same thing, we sell a contract at the 26 delta, which is closest to 30. You see the 26 or 37, so of course 26 is closer. And that lands us at the 76 strike. So we sell the 76 strike contract and we collect 42 cents up front, and our broker is going to require $1,370 of buying power. Now this is because it's a much larger underlying. Now let's say, for example, you didn't want to allocate that much buying power to any one position. Let's say you have a smaller account, whatever it may be. What you can do to manipulate this position to fit inside your portfolio is use some of this premium to buy another contract a little bit further out. So let's just say we buy another contract, say $3 out at the 73 strike. So we sell the 76 and we buy the 73. Our premium has reduced because we've used some of the premium to buy the further out of the money contract. However, our buying power requirement has significantly been reduced now. This is because our max loss is significantly smaller. Our max loss is now defined by the spread in between the short and long contracts minus the premium we collect up front times by the contract multiplier, which gives us a max loss of 270. Our broker only needs to hold whatever our max loss is, so it only requires 270. And now you'll notice we have a much higher return on capital, again over 10%, which is similar to what we observed with EWZ. So that's how you can find and manipulate positions to fit inside your portfolio. Whether it's a smaller underlying, you can just go naked. If it's a larger underlying like XLP, you can just buy another contract a little bit further out to cover your short and reduce your buying power requirement. Now the only question left here, just before we do that, if you notice here, we've got a P50 of 98%. So very, very, very high probability of success here with this trade. Now, how do we know how much buying power we should be allocating to our positions? Well, in order to figure that out, we've got a free position sizing template that everybody can get a copy of. The way it works is you enter in the size of your portfolio, you then enter in whatever the current VIX level is, and everything will then be automatically calculated for you. All you need to do is use this information to form the backbone of your portfolio. It tells you the maximum amount of buying power to allocate to any single defined risk position, undefined risk position, how much of your portfolio you should be allocating to short premium strategies. And as long as you follow this, you'll be absolutely fine. If you would like to learn in more detail about what we do and how we do it, again, link will be in the description. This time, click on EDS Premium, get yourself signed up. Inside, we will give you access to our portfolios that will allow you to see the positions that we're placing, how we're managing risk, how we're making adjustments, etc. There's also a full course, so no prior knowledge is required. We will teach you everything that you need to know. It's a private community, so if you get stuck, you can speak with myself directly or with other like-minded individuals. There's also a 100% money-back guarantee, so once you have studied through the full course and followed our trades for at least 6 months, if at that point you haven't been profitable, then we will work with you for free until you are, or you can simply request a full refund. So it's completely risk-free from your side. It's £1 a month to join right now. It's super cheap. It costs less than a loaf of bread or less than a coffee. The reason why it's so cheap is because we've just launched. The price will be increasing. However, once you're in, the price is locked in for you for life. So you are definitely rewarded for getting in early. And the aim of EDS Premium is to get you to a point where you've learnt the skill of being able to write contracts consistently. You know how to manage risk, you know how to make adjustments. You've learnt the skill, and it's something that no one can take away from you for the rest of your life. We aim to get you to that point within 6 to 12 months. You are always welcome to stay and be a part of the community, but 6 to 12 months and you should be good to go. So with that being said, I will see you guys on the inside.